Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at McCormick and Company. This was a subscriber request video, so we're going to do a stock analysis on McCormick. But before we get into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get good ideas of potential stocks to buy or value traps to avoid, make sure to subscribe to my channel. So let's jump into the analysis now. And I'd like to first look at a few of the top, high-level things on the Guru Focus page here. So sometimes this little Guru Focus value band can be accurate for companies that do have consistent pasts, and that may be the case for McCormick here because it is showing they could be a little bit on the undervalued side right now. They also currently have a current PE of 26.71, but their forward PE is a fair bit lower at 21.55. And also for you dividend investors there, they are a nice dividend stock with a dividend yield of 2.43% with a dividend payout ratio of 0.64. So now let's jump into the financials here. So first thing you can see here, the green line here is the revenue growth trend, which has been very, very consistent. Basically over the last 10 years, they've been growing at 4.8% per year. So they're definitely not a growth company, but they do tick along at a steady pace. They do have EPS growth average over the last 10 years of 7.9%, which is a little bit better there. So one of the things I like to check is return on invested capital over weighted average cost of capital. This is important, especially if the company has to issue shares or take on debt. You want return on invested capital to be a higher number. And they've been pretty good in the past with the return on invested capital, although it has started slipping since 2020. So we're going to have to determine if this is because of some problems within the company, or this is just the overall economic factors which have been affecting everyone. But on the good side, their weighted average cost of capital has been quite low, always under the return on invested capital, except in this last current year. So this is a little bit of one-off right now. And as we go down a little bit further, I just want to highlight one little thing here, which I don't always go in all stocks here, but is the inventory to revenue ratio. Since there was the supply chain issues in 2022 and that kind of, caused problems, people over ordered. We can see if the inventory to revenue ratio has gone up, they may be sitting on a little bit of excess inventory, which may explain some stuff we're going to see in the financials. And you can see basically in the last 12 months here, their inventory to revenue ratio has gone up to 0.2 when historically it was about 0.14 to 0.17. So this is definitely abnormally high right now and may explain what some of the stuff we're going to see next. So we see they've had very nice revenue growth over the years here. It has been a little bit pokey in the last few years. And again, there's been a little bit of economic headwinds, and that's also what we're seeing in the gross margins. They basically were quite good with their gross margins before, being around 40 to 42%. Before this, even 2017, 2018, they were slipping down, but they were getting back to 41 in 2019 and 2020. But then come along 2022, they've slipped around to a 36% gross margin, and then in the last 12 months it's 36.72. So this kind of might mean because they have a little bit of surplus inventory, more than they normally do compared to their revenue, maybe they're a little bit overstocked and they're cutting their prices to move out this inventory. That could be an explanation for it. So maybe this isn't meaning they are losing their competitive edge, and we could possibly see them revert back to their gross margin of 40%. But on the positive side here, their operating margin has actually been relatively, in a way, getting more efficient. We look back in the past year, they're around 13, 14, 15% for a lot of the years. And basically in 2017 going forward, they got more efficient, and they're basically cutting their selling and general admin relative to what their revenue is growing, which is a really good thing you want to see in a company happening. And that did raise it up to about 17, 18%, and it has come back down because of the gross margins to around that 15%. But if they do get these gross margins back up in the future, we would expect to see the operating margin rise as well. So we go down next and look at their interest expense here. So interest expense has got a little bit higher, rates are higher, maybe they've taken a little bit more debt. And frankly, it's a little bit higher than I would be comfortable with. Before they were a lot better in the past. Right now, they're sitting at $200 million of interest expense with only operating income under $1 billion. So that's about a 1 to 5 ratio. I usually like to see companies with at least a 1 to 10 ratio. It's just something to be aware of, that they do have they're a little bit high on that interest expense. So hopefully they'll be able to pay down a little bit of debt, or they'll be able to get that operating income back up when their margins recover. But you can see in the past year, it wasn't as bad. 136 million compared to $1 billion in operating income, much better ratio than 986 million compared to 200 million of interest expense. So not terrible, just something to kind of watch to see how that develops in the future and if it gets better or worse. then we can basically see net income has been positive all years, even 2008, 2009. They are a consumer defensive company. If you don't know already, they basically are a manufacturer, distributor, and marketer of spices and extracts. So, spice and everything nice. And so when, recessions do hit, they are able to still stay profitable. So, this, if you do want to get a defensive portfolio, it is kind of stocks like this you want to start looking at. And you can see basically the shares outstanding, it's gone down a little bit, it's gone up a little bit. They sometimes issue shares, they sometimes buy them back. I think a lot of this sometimes is stock-based compensation. But over basically this last, 10, 15 years, it's been at effectively pretty flat, a little slight increase. But they're not really returning any capital to shareholders through the share buybacks here. So we check out their balance sheet. Let's take a look at their current assets. And there you can see total inventories a little bit on the high side compared to the revenue, and that's what basically that ratio before was reflecting. But basically total current assets sitting just over $2 billion and total current liabilities sitting above $3 billion. So this is a bad current ratio. If they were a smaller company, this would be, and actually potentially losing money, this would be something you could be concerned about, but I don't think for them that's the case. I think the reason why basically the current liabilities are this high also is going to explain why their interest expense is a little bit higher, is they basically have some short-term debt, which is variable rate interest debt, which is why it's been rising. So you can see right here, short-term debt here, $1.4 billion. And basically these are lines of credit companies get of basically working capital. But as interest rates have gone up, it's probably made the interest expenses higher, which is why we're probably seeing more interest expense they're paying. So basically, as interest rates come back down, we should, even if they don't reduce their debt, we probably would actually see the interest expense come down. So that's just something to keep in mind there. We look at basically the total assets, almost at $13 billion, although over $5 billion of this is goodwill, which we're going to have to take out because they have done some acquisitions. And with total liabilities of $7.9 billion, that gives total stockholder equity of about $5 billion. But again, they have just over $5 billion in goodwill. So really at the end of the day, there's no really tangible equity left on their balance sheet. So overall, not the greatest balance sheet. I'm not seeing any really big pluses here, but there's not really anything that's really a big disaster. It's just, if interest rates stay high and they took on more basically of this short-term debt, that could be bad for their interest expense. But also we realize because of this, when interest rates come down, it's going to mean they're paying less interest expense in the future, which is an important thing. So we pop over to the cash flow statement. And as I said, with the stock-based compensation, you do see there's a little bit of stock-based compensation going on here, which is kind of causing that dilution. I also like to look at the cash flow from depreciation here, and you can see basically it's been, from around 100 million before, it's gone up to 200, pretty steady, nothing unusual there. But the purchase of plant, property, and equipment has been going at a little bit higher rate, which for a company that is growing, this is something that kind of would be expected. But you also then have to consider what you are seeing on the potential balance sheet there is their assets may be a little bit overstated since they're having to replace them at a faster rate than they're depreciating them, unless these are actually new assets because the company is growing the scale. Just something to keep in mind there about their balance sheet. Then we also see basically the purchases of businesses. They have done some little acquisitions along the way, and in 2017, a really big acquisition as well, which seems to have helped them overall from all the other metrics. This was also, I'll say, when their operating margins got more efficient. So when all these companies talk about doing acquisitions and the synergies, I think this is actually what happened here, because let's just look at 2017. Let's pop back up to the income statement here. And yeah, 2017 is basically when we saw the boost in the operating margin. So they were able to get a nice boost in revenue, but they're selling and general admin. They were actually to keep that more under control. And that's probably was, some of the synergies that were created from that acquisition, which is a pretty good sign. So they do have, I would say, a history of doing some good acquisitions from what I'm seeing there. You can also see there was this little one time when they did issue a little stock during that acquisition, but normally they kind of do repurchase a little bit, but you can tell over the last 5 years or so, it hasn't really quite been enough to offset the little bit of dilution they have. But not really a big deal. You have to realize you're not going to be getting any return basically to your shareholder through share buybacks because they're just offsetting basically what they're issuing at best. And then their cash flow from dividends has been very good. It's been increasing over time. It's at a manageable level. And from all the other numbers I've seen before, I think they're going to be easily be able to pay this dividend and probably wouldn't be cutting in the future unless something disastrous happens. And then you can see free cash flow, very good overall. So Now it's all pretty good for McCormick, but what does that mean for the valuation? So let's pop over to the interactive chart here, and I'm going to kind of get an idea of what the relative valuation and maybe price I would buy it at. So let's first pop up the revenue with estimate here and the EPS estimate to get an idea what the average analysts basically think. And more or less, they kind of expect things to keep ticking along on the mean they have before. So that's pretty good for the type of relative analysis that we're going to be doing. So let's get rid of those here. And now let's pop up the price to sales ratio. And as we're waiting for that, let's just shorten the chart a little bit here since we don't have data before that. And let's take off the price so we can see a little bit cleaner things. So you can see there has been some multiple expansion up, but I will show you that there is a good reason for this. As we said, basically the operating margins had risen, so therefore we are going to also probably see a rise in the net margins here. So as you can see here, basically back in the day, net margins were a little bit lower. Net margins then basically from say 2010 going forward were a little bit higher. They did get back really high after their acquisition in 2017, and they were around 13%, and they have dipped down a little bit. So a lot of your decision in the valuation of McCormick here is going to come down to if you think their net margins are going to come back down to this level around here, where they're around 8 to 10%, or are we going to basically increase back to where they were around 13% or potentially even higher. So I don't know if that's going to happen. I would say, again, if they get their inventories problem solved and we see that gross margin go back up, they're going to be getting back up to this 13% level. If there's continuing headwinds, they're probably going to come back around to this 8 to 10% level here. So, and you can see that, then it kind of makes sense why the multiples have expanded like they have. So the level we're at here, could be relatively good because we have got back to some of these periods kind of in the middle of when they were trading at a little bit lower net margin, leaving a lot of potential upside. Another way I like to do it, of these consistent dividend payers that grow very steadily, is just look at the dividend yield. The dividend yield can tell you a lot in many of these scenarios here. So basically when the dividend yield gets high, the stock a lot of time is relatively a good valuation. And we compare this to the price. And what do you see? Basically 2008, 2009 great financial crisis, great time to buy it. When the stock was at 2000 here, there was at relative lows, dividend yield was high. And right now our dividend yield is getting high again. Let's just take off the price so we can see this here. It's at 2.4%. So I'm just going to draw a line here just so you can kind of see where it is. So we definitely are, by some metrics, getting into a good value zone. Although you can see from these higher peaks here, it is potential that McCormick could get cheaper from a relative value perspective. So now let's jump into basically the stock chart here and, kind of fuse these fundamentals with a little bit of the technicals here. So this is like basically my pitchfork trend here. Pretty accurate and representative of McCormick here. So basically, they could just hover along in this top channel here, but if companies do have basically a decline, which does happen sometimes, and they were to go into lower margins, they could potentially drop lower. So that always is a possibility, but if they kind of do start reverting and upping that gross margin again, I would expect this larger top trend channel to hold. And that could mean right now, as you can see, where they're coming into this basically red 100-month moving average. This has been previously a good time to buy the stock in the past. We are already through that right now, and it's come down. It hasn't had a lot of consolidation, so I wouldn't be looking at jumping in quite yet. I've also drawn this $52, $53 level here, which is a kind of potential support. It could come down. So I think that McCormick could potentially be at a very good value, but might get to a little bit of a lower of a valuation. As you can see from a lot of these bottoms it's traded at the past, you're not going to typically have 1 month come down and immediately go back to the top. I think you can wait on this stock right now, wait for it to come back down, start bottoming a little bit, pick it away. I would be very interested if it basically starts getting sub $60. So, that's my thoughts on McCormick. I hope you liked the analysis. If you did, make sure to subscribe to my channel, Balance Sheets Matter, like the video, and leave a comment in the section below if you do want me to look at another stock in the future.